I don't think we're at the euphoric stage yet. It's been kind of like a slow, really FOMO, fear of missing out stage. FOMO is not quite euphoria. And the longer that we sit in this market that just won't correct, and every little micro drop has been rescued by money printing, and the longer that we sit in this, I'm more and more convinced as I see these corrections that come right back to new highs faster and faster, that we're going to have to really see the mother of all euphoric pinnacles here.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. I'm welcoming you here. Joining me and my good friends, John Lodra and Mike Preston, the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. You've seen them here on this channel with me week after week after week in the past. We are going to try something a little bit different today, and if it sticks, we'll keep with it going forward. John and Mike and their team there at New Harbor, they're great people, salt of the earth. Obviously, those you've been watching already know them quite well. But they're really based in sort of the practical so what of all the issues that we talk about here on Thoughtful Money. Okay, if you think the future is going to look like the way Lacey Hunt sees it, or Danielle DiMartino Booth sees it, or Darius Dale sees it, or any one of the people that come on this channel. And also, if this is happening in the macroeconomic environment, if these are what Trump's policies are going to be, okay, so what is all that going to mean for me as the individual investor? How do I put together an actionable plan from here? So at John and Mike's behest, we're going to try this new format here that's going to try to dig into a little bit more of the practical how-tos than what we normally get into on this channel. We'll talk a little bit about macro first. We'll set the stage, but then we'll get into some actual, hands-on sort of, steps you can use to improve your situation type content. John and Mike, gentlemen, thanks so much for joining me.
Hey, great to be with you, Adam, and thanks so much for giving us this platform. It's really what we love to do, and it's inspired by the work we do every day with our clients that applies what we see and view in markets to their lives and their specific situations.
Look forward to the talk, Adam. Thanks for having us here today.
All right, gentlemen. Well, look, maybe just to sort of set the stage a little bit, a lot's been going on in the world. We have a new president-elect with a very ambitious and very seemingly disruptive set of economic policies that he's already chomping at the bit, it seems, to implement. Why don't we just sort of, get a sense for how you guys see the macroeconomic environment right now, and then talk about some of the things that maybe most of the individual investors watching now should key steps they should consider taking, either given the macro situation or the calendar, because I know we're coming up on year end as well, and there's a lot of year end planning steps that we've been talking a lot about in this channel. John, why don't we kick it off with you first, because I know you guys you put out your own videos at New Harbor, and you just put one out on basically repercussions of the election. So how much of a change agent do you see this new presidential administration being into the mix?
Yeah, Adam, I think I probably speak for most people, regardless of their political stripes, that it's good to have the election behind us, because the circus that we all sat through, I was getting texts on my phone almost every day from both sides, with all kinds of propaganda, and just happy to have that behind me. Maybe I'm alone, but I don't think so. There's a lot of slogans or cliches in investing. One is, for example, buy the rumor, sell the news, right? And it's funny because election cycles, if nothing, are all about headlines and promises and sound bites and whatnot. And we certainly have seen a bunch of that. But if you zoom out over the course of economic and investment history, it's not those headlines or the promises. It's bigger picture stuff that ultimately come to guide and drive what happens in markets. And we did some looking at this, and certainly in the short term, there's going to be all kinds of gyrations that are headline driven. But when you zoom out, and we might say, okay, Trump is in office and we have a sweep in Congress, so we have a Republican sweep. What might that mean for the years ahead? We know all about the headline policies, tax cuts, deregulations, cut government spending, all these things that sound great in the surface, and certainly in a vacuum are markets anyways would more or less cheer, but it's not that simple. In fact, we can go back to the last time that we had a Republican sweep, and that goes back to the turn of the century. Basically George W. Bush's administration. So here's a headline: what Republican sweep means for Congress. And again, the last time we saw this was during George W. Bush's reign. And many folks may not remember this, but his two terms, both terms saw the stock market, for example, if we want to talk about the stock market, lose value. They were negative returns if you looked at the S&P 500, for example. And that's despite the sweep of Congress and the executive suite. That's despite a focus on tax cuts and things like deregulation, things that are very similar to what Trump is talking about. And we can point to one main reason, I think, and we think, that really is synonymous with where we are right now. And the fact that the stock market, broadly speaking, was tremendously overvalued. When Bush entered office, it was right after the very tippity top of the tech bubble valuations. This is a long-term chart of what's called the cyclically adjusted PE ratio. It's basically how expensive the market is relative to the earnings over a 10-year period. And you can see right now we're at a level that is very much almost identical to where it was when George W. Bush entered office. And of course, the natural consequence of that eventually was that markets struggled very healthily. And it says nothing about the short term. We're actually kind of bullish in the short term, to be frank. We look at a lot of different indicators, and all our indicators they've been whipsawy of lately, but they're speaking very bullishly about the near-term direction of the market. But even though the broad market may struggle, and we do think it will struggle over the next 5 to 10 years, and probably the bulk of this current administration's term because of the valuations, there are areas that likely will do well. And this is, for example, what the Bush presidency looked like. Even though the broad markets, the S&P lost money, there were several sectors and asset classes that did very well. Gold, energy, materials, they did very well over that time frame. And even on a broad asset class level, even though the S&P 500 and the NASDAQ lost, soundly over that period. These are the first term, second term, and the duration of George W. Bush's administration. There were broad areas that did quite well: emerging markets, foreign emerging markets, commodities, small and mid caps, because they didn't share the same kind of egregious valuations that the large cap S&P 500 type companies had. So nothing ever repeats in history, but there are enough things that rhyme that we think that these are the kinds of things that will likely govern where we go in the years ahead, more so than the headlines of policies this or policies that.
All right. It's interesting. You talk to two different economists, you get 10 different answers. I've had a lot of people on the channel recently where I've asked the question, forgetting kind of how we got to this point for a moment, just starting here, looking at President-elect Trump's economic agenda, highly disruptive, right? You've got the threat of tariff and trade wars. You've got the planned deportation of millions of undocumented residents, many of them who are working under the table, in this country. You've got the gutting of the government bureaucracy, meaning lots and lots of job cuts in the government sector. So the natural question is if Trump wants to be successful in the long term with those goals, can he get there without a lot of kind of serious disruption and maybe some serious pain in the short term for the economy? Most people I've talked to have said no. It's going to be just like an alcoholic. The pathway to getting better is to take the bitter medicine, go through the withdrawal pains, right? But then you talk to a guy like Art Laffer, who has advised many different past presidential administrations, both Republican and Democrat, and he could not be more optimistic about how the Trump presidency is positioned right now. And I pressed him in my recent interview with him on this about, okay, but can we really get there without this pain and disruption? He said, look, some things have to happen. There's no guarantee that it won't. But he said, if this is done intelligently, yeah, we might not really have to take that many lumps between now and then. So, but it's a big unknown, right? It's a big uncertainty. John, you're nodding as I'm saying this, and kind of where I'm going with this is, if there is potential for disruption, and if market valuations are as high as they are right now, and you showed that list of the cyclically adjusted PE ratios, John, showing that they're right back up, really where they've only been exceeded once before in history, but they're literally right where they were when George W. Bush took office, where we had the exact same setup we have now, meaning a Republican White House and Republican Congress. Sure looks like history could be repeating. So you said that you're kind of bullish in the immediate term, right? Meaning that this party could still go on for a little bit more. But how do you think about managing capital in this type of environment, right? Is the type of environment where you just don't want to touch the risk and you just want to be in cash and you're going to let the party run without you? Is it the type of party where we'll take the Chuck Prince quote where the music's still playing, so I'm going to stay on the dance floor, but I'm going to try to be close to the door? Or is it just be bullish until indicators tell you otherwise?
Yeah, Adam, it's certainly a big part of our job, and here's where nothing about this is all in or all out, and this is where we want to emphasize every chance we can that it's about our clients and each client's individual situation. There are some clients, frankly, that don't want to take the risk. They're worried about the risk, and they won't sleep well at night if they take the risk. So for all intents and purposes, that client, regardless of what our near-term view about markets are, we can talk to them about, playing it safe, right? Because there's certainly an argument to play it safe. But we can kind of have it both ways. What we try to do is bring sophisticated tools to our clients without getting them bogged down into the mechanics of them. So for example, we are skilled at the use of options to hedge risk. And we can be invested in the stock market while at the same time hedging against major downturns. And we, in fact, have positioning like that in our portfolio for our clients right now. I won't get into the details, but suffice it to say, you can kind of straddle both sides of that fence without taking undue risk. And that's really what we try to bring home to our clients, using our skills, but in a way that they understand and empowers them to be less stressed out about these things, frankly, in their lives. Mike, I'm sure you can add much more color to that.
I'll give you my take on that question. In my view, you can't have your cake and eat it too. You can try and have a little bit of the best of both worlds, but you can't stay fully in this market that by all measures is completely overvalued. And even though it feels like a permanently high plateau, it is not. And if history has anything to say about it, and I think it does, we're going to see a drop of 50% or more, maybe 2/3 or more from the ultimate peak in the market. So it would be nice to be 100% in, ride it to the top, and get out at the tippity top. That's what everyone wants to do. That's what human psychology wants to do. At New Harbor, I think that what we're willing to do is what a lot of other money managers aren't willing to do, and that is to set a risk exposure at a lower level based on the prevailing conditions. And presently, right now, we're only about 38 to 40% equities if you ignore the gold stocks that we have in our portfolio that we think are a little bit different. So at 38 to 40%, we're certainly not all in. And we'll certainly give something back if the market would turn and crash tomorrow. We have protection in place. Down about 5 to 10% below here, we've got some puts in place that would kick in and protect us. Now, we're hoping that we've got enough skill along with our hedges to not give anything back on the turn, and certainly don't want to get very hurt on a crash if that were to happen, because make no mistake, we are playing in a dangerous environment. And that's why we have set our allocation down to where it is. Now, for the average individual investor that can now get 4 to 5% on treasury bills, I got to tell you, based on where we are here, I don't think it really makes that much sense to try to play this game anymore. And we are on record, and we'll say it even today, that we think the market is likely to go higher in the near term. Maybe in the next couple of months, we see a little bit more of a vertical move or a blow off top even. I know that term is overused, but it looks like that's what's gearing up to happen. Don't bother. The average person shouldn't bother. And we're not here to say that we can have our cake and eat it too, but we're trying. We don't want to give anything back on the turn, and we'd like to even make money on the way down if possible. It's very, very difficult. But I think that what we do here at New Harbor is in plain language. We try to help people. We meet people where they are psychologically and financially and help them figure out if that's even worth it for them.
Okay. And, we've talked about this many times in the past, but that for Investors of all stripes, but particularly the individual regular person investor who perhaps, you know, they're not a professional investor. They've got a real life that occupies the vast majority of their time and their focus, right? Where they're human beings and their emotions oftentimes get in the driver's seat, and that's what drives a lot of their investing decisions. And we've talked many times about how that then almost always leads to subpar decision making and subpar performance. So, Mike, I want to get your thoughts on this chart here. So this is a chart of the classic psychology, of a market cycle. And you can see here that people become increasingly optimistic and then euphoric. Then the market hits its blow-off apex. There's a correction. People basically deny that anything could be wrong. They're still complacent. And then the market starts deteriorating, and they're kind of, their eyes don't believe what they see, and their emotions, it keeps getting worse than they can imagine, up until the point where they just completely panic and capitulate. So this is a very classic, composite chart of past market bubbles and the emotional milestones along them. Where do you think we are here? It sounds like you think we haven't hit the top yet. So are we at the thrill stage here, or are we purely at the euphoria stage here, where I'm just an absolute genius and I'm going to keep throwing all my money in here because of course it's going to the moon?
Well, full disclosure here, Adam, I'm not a genius, and I don't have a 100% track record for predicting the future either. And I've got to be honest, there's more than one time in the last 20 years that I thought we saw euphoria, and yet it was only a minor mountaintop, not the mountaintop. So you can go through some micro cycles here. But I've been in this business long enough to have experienced most of these. I've been in this business since 1999, going on 25, 26 years now. And I can tell you that there was a time, looking at the bottom of that chart, I think it says to them something about who shorted the market, and people are angry and they want the government to ban short selling. That kind of thing is what you see at a major market bottom. And we had some of that back in the tech bubble, I remember, and even some of that in the housing bubble. Both of those crashes, the 2000 to 2002 crash and the 2008 2009 crashes, were mini crashes, in my opinion, and both were rescued through interventionist monetary policies. And we think the next big drop, even though the federal, the Reserve and other central banks will try to rescue it, we very well may see the market fall anyway, and that'll be really scary, and we'll see a true bottom. But to answer your question, I don't think we're at the euphoric stage yet. It's been kind of like a slow, really FOMO, fear of missing out stage. FOMO is not quite euphoria. And the longer that we sit in this market that just won't correct, and every little micro drop has been rescued by money printing, and the longer that we sit in this, I'm more and more convinced, as I see these corrections that come right back to new highs faster and faster, that we're going to have to really see the mother of all euphoric pinnacles here. And now maybe me saying that is a good marker that the top is in, because certainly haven't heard me say anything, or us say anything like that in a lot of other videos in years past. But I can almost feel it in my bones that we're going to have to get some kind of finality here that's going to end this 40-year bull market. And so if I had to guess, I'd say we're entering thrill. We're entering the thrill area, and euphoria, it probably is in the next 1 to 2 quarters, if I had to guess. We've got a setup here that could lead right into the inauguration.
Okay, and correct me if I don't want to put words in your mouth here, but it seems like the euphoria stage is a very brief one, right? You look here in this composite chart, and you go from thrill up, and then it comes back down. In other words, you're not expecting the euphoric stage to last for quarters or a year, right? It's more something that's much more of an event, correct?
You'll know it happens if you see, for instance, the S&P, which just reached it's a 6,015 right now, so we're above 6,000. If you see the S&P go to 6,500 or 7,000 in the span of 2 to 3 weeks, maybe 1 month, that's what we're looking for. And I think the NASDAQ nearly doubled in a few months back in 1999, when I was a pretty new broker at a company called Payne Weber back then. That was something to see. I don't think the S&P will double, but I think you might see 1,000 points in a month. And that could
Okay.
even happen in the next month.
And a lot of people watching are, I'm sure, thinking that surely can't happen. But that's what these psychological cycles are all about. At the top, things that you just don't think can happen start happening, and they start happening quite quickly, which is why people say, "Oh my God, I was wrong, and I got to get in this thing because it's a different world," right? And it's the same thing on the way down, right? They just don't believe what their eyes are seeing them. Surely it can't go down anymore. Of course, it's going to come back up, and that's when I'll sell, right? And then it keeps falling. So the key thing here is to really be aware of your emotions, because they oftentimes will tell you to do the wrong thing at precisely the wrong time. And John, I'll let you comment on this. You know, sometimes people will hear you guys talk about overvaluations and caution and hedging and stuff like that, and they'll say, "Ah, come on, guys. I mean, you just sound really bearish. Can't you be excited about all this?" And you know, hey, bulls make money, and you know, bears watch the party pass them by. I want to point to this inserted chart here, right? That says simplified market cycle, and you see at the peak, it says that's the point of maximum financial risk, right? And you see the trough, that's the point of maximum financial opportunity. And I think what you guys are trying to do is not be wet blankets, but you're just trying to be aware that it's all about risk return. And when you're up at the thrill and euphoria side of the chart, that's where it's the risk is asymmetric to the downside, right? Yeah, maybe you'll pick up some pennies in front of the steamroller, but if you're not nimble, the steamroller could very well squash you, right? And I know that you guys are excited, not about the pain that it's going to be taken as markets reprice, but you're excited to be really bullish, you know, if indeed we do have a blow off top and then things correct, to be one of the people who's well positioned to be deploying assets when valuations are much better and much more advantageous to long-term, you know, wealth building. Did I have that correct?
Yeah, that's exactly right, Adam. And you know, I oftentimes will talk to clients about the reality, and this is the brute reality of investing and emotions, is there will be infinite opportunities for regret when you are investing. And the best thing one can do as an investor is to be okay with regret. But there's many different degrees of regret. There's a regret of perhaps getting out of the market too soon, like just before that pinnacle top. So maybe we are in the, I forget the actual phases in that chart, but maybe we're not quite at that final euphoric blow off. But
Right. Thrill was before euphoria.
one need not be in it right to that point, even if they could call it precisely, which no one can. We'll be the first to emphasize that with conviction, that no one can. It may be lucky to do that, but there's the idea of regret of being out a little too soon, perhaps, and missing out on that last stage move higher. But there's also the regret of, you know, not selling soon enough and suffering that first 5% decline that feels like just an ordinary decline, but is really the early innings of that 30, 40, 50% decline. That's why people get trapped in bubbles, because they bargain with themselves. And typically the regret of de-risking too late is much more costly and much more damaging to the real purpose of why we're doing this, why clients are entrusting a firm like ours to help them. It's not so they can win some contest at the local club or whatever. It's so they can live comfortable lives and provide a paycheck for their retirement years and live comfortably and hopefully stress-free. So our big part of our job is, of course, getting into the nuts and bolts of the markets. Mike and I are engineers by training. We get a high off of analytics and math and logic, but the real important thing we do for clients is help them come to terms with their psychology, you know, empower them to put fear in check. Fear can come in many forms, including fear of not having enough, fear of missing out. There's all kinds of things, and that's a huge part of what we do in the day-to-day application of our work for clients. I will say that, you know, we can look at those euphoria charts and, you know, we can talk about the market as a whole, but there are certainly some areas where that maybe is more pronounced than others. And I'm gonna pick on Bitcoin a little bit here, even though we have largely been out of Bitcoin. We had a very short-term purchase for clients in Bitcoin right leading up to the election, and we sold it just last week on a very sharp bounce. Ended up going a little bit higher in the near term, but it's since pulled back, and we'll see where it plays out here. But there's all kinds of stuff out there that are emblematic of major tops. Some people might be familiar with a stock by the name of MicroStrategy, and Michael Saylor, the CEO, or actually the chairman of that company, is a very outspoken Bitcoin proponent. There's some really wacky stuff that's going on there. Basically, the company has a software business that is, not really making a lot of money, if any. In fact, it's losing money. But what it's doing is it's using its balance sheet and its ability to issue stock and issue convertible bonds to what they call create a Bitcoin treasury. They're basically literally raising funds from the public to go buy Bitcoin. And right now, the value of the stock, well, actually, I'll share a chart of the stock, just show you how much it's moved of recent times. And this is going to be a story that's still written. But this is the ascension of MicroStrategy stock, and it's just in span of a week, it's gone from 540 down to 350. That's a huge move. Now, this is basically the value of the Bitcoin that the company owns. The market cap of the company got to like 3 times that. So there's a lot of, and I could share a video that has Michael Saylor talking about. He was on CNBC trying to explain what the strategy was there. And I got to tell you, for the unsuspecting public, I feel sorry for them because we're pretty versed in these technical terms, and it sounded like a really bizarre, sales pitch basically. And it's just, these are the kinds of things you see at tops. Maybe it's not the top of Bitcoin, but it speaks to a broader speculative environment that ultimately will find its top, and probably on some nondescript day where there's no particular headline, there'll be a pullback, and that's just what happens. That's what happened in the October of 2007 when the housing bubble finally started to burst. There was nothing particularly on that day that caused the market to top. It just did. And it wasn't until several months later that the real headlines of dire consequence started coming out. So these are the tricky things that market psychology create for all of us, frankly.
All right. Well, great background, and I do want to get to some of the practical stuff that you were just referencing there that you guys really love to do for your clients. Real quick though, on this topic of psychology, two stories. One, when I graduated from business school, a classmate of mine and I applied for the same 2 jobs. And we both wanted the job at the startup, which I actually ended up getting. So I was feeling pretty good about that. She ended up going to work for Yahoo. And folks may know I ended up eventually working for Yahoo, but this was not until a few years later. So we were like a month or 2 out of business school, a few months out of business school, and Yahoo stock just started going bananas. With the height of, we were getting in the thrill phase, close to the euphoric phase of the .com bubble. And I remember, we reached out and said, oh, let's have lunch together. We went and we had lunch. So I sat down, had a nice 1-hour lunch with her, got back to my desk after the lunch, and Yahoo stock had gone up so much that I remember, what the option grant was, because I was competing for that same job. And I did my little back of the envelope math, and this is when I was a poor student. I had nothing but my business school debt on me, and I was like, "Oh my God, she just made like $500,000 while we were at lunch," and I paid for it. And here I was at my startup that ended up, eventually getting caught in the whole, .com buzzsaw. Not that later, but anyways, it's crazy things like that may start, like that's a sign that when you're probably entering the euphoric crazy stage. All right, the other thing I wanted to put up here too was the oh shoot, give me just a second, guys.
Adam, while you're doing that, a fun little experiment. Many of us are going to be around Thanksgiving tables in the coming days, and it's always a good litmus test experiment. The kind of conversations. Maybe the people around you won't be talking about markets and financial things, but if they do, put your radar up, because that's usually a pretty good litmus test of the social mood and level of exuberance. The more willing people are to and eager to talk about these things is usually closer to a top than a bottom, but remains to be seen.
It's pretty right. It's probably going to be a rough Thanksgiving, because you're going to have some members of the the dinner table who probably were for a different team than you on the election. So you're probably gonna have that awkwardness. You're probably gonna have a few there who have made a killing in Dogecoin or something like that. It's probably steel yourself emotionally before you head to the Thanksgiving table this year. All right, the chart I just wanted to show was this one, and again, this is another, this is a specific bubble chart. This is the South Sea bubble, and this is the one that famously Isaac Newton, one of the smartest men in history, lost a lot of money at. And you can see here he got caught up in the emotion, right? He first gets in down before the bubble really takes off. He then exits. And he's happy. He had a great return, right? He wrote it from what, 175 to 375, right? But then the bubble really starts hitting the euphoric phase in a very short period of time, measured in weeks here. His friends who stayed in are just getting rich. Newton finally decides he can't take it. He must have miscalculated things. I got to get in on this. FOMO is raging in his ears. The thing peaks just a week or two later, and then you have the whole bubble capitulation part, and he exits broke, right? And the key thing to note here is, hey, again, this is just the normal trajectory that bubbles take and the emotional milestones along the way. But if Newton had just exited happy and not jumped back in, not gotten caught up in the FOMO, he'd have been sitting pretty, right? These shares would have gone back down to close to worthless, and he would have been sitting on a massive gain and would have been perfectly happy. But he just got sucked up in the crazy raging emotion that bubbles have. And I think, that's one of the things you have to do going into periods like this, is just understand history so that you can kind of hopefully steel yourself from the siren song of those very powerful emotions, as the people around you who maybe aren't exhibiting a lot of proactive thought are still making money hand over fist in that very crazy blow off top phase. And again, that's why professional advisors like you guys are such a helpful circuit breaker for people, as you can, as they're calling you up and saying, hey, should I really jump back into MicroStrategy right now? You can walk them through the logic and say, look, is that what's needed to hit your goals? Or if not, can we find another way to do it with much better risk return ratios? All right, gentlemen. Well, look, let's get to this next section here about just practical steps that folks should be considered taking. I've mentioned a fair amount of times on this channel for folks to really be cognizant of the fact that year end is coming up fast. And there's an awful lot of steps that people can take in year-end planning to really end the year strongly. Like, a lot of people might be sitting on great gains, where taking some of those gains off the table just might make sense from a diversification and safety standpoint. But then you can also use tax loss harvesting to offset those gains. There's a lot of stuff you can do, but you got to get it done by the end of the year. So gentlemen, I know you put together your firm's own end of year planning checklist you think folks should look at, but what are some of the most important things you think the greatest majority of folks watching this video should make sure they at least consider doing before the new year arrives?
Adam, I'm just glancing at our checklist. And by the way, I know that you've distributed one, or you have one on your site. We have one too at New Harbor. Feel free to reach out to us through the Thoughtful Money website. We'd be happy to share that to you. If you contact us, we'll share our checklist with you. But year end, the big things are going to be Roth conversions. That's a hot topic. Charitable giving, this is a hot topic. Contributions in general to retirement plans is something that we would review. Many of them do have deadlines that extend into next year, April 15th, for many of the retirement plans like Roth, traditional IRA, and SEP IRA, but that doesn't mean we shouldn't be talking about them, deciding whether conversions make sense, and even planning to make the contributions. Now, required minimum distributions is a really hot topic. You've got to, if you're 73 or older, you've got to make a required minimum distribution for the end of the year. If you've got an inherited IRA, you're going to have to start taking distributions next year for decedents that passed after January 1st of 2020. The IRS basically didn't give good guidance, and people have had a pass in that they've got to get the money out within 10 years, but they really didn't have to do it every year. We recommend that they do, including 2024. Otherwise, you just have more to do later. But starting next year, you definitely have to start taking money from those inherited IRAs. These are just a handful of topics. There's others. Gifting. Gifting, we have to talk about gifting. There's an annual gift tax exclusion. Many people that have very high net worth as part of their estate plan. We talk about gifting. For people that are over 73, they can gift directly out of an IRA. The limit is $105,000 for 2024. And there's more. I don't want to throw too much out there, but these are just a handful of things we're talking all day long with people about. Again, we're happy to send the list to you if you reach out to us through Adam's website, thoughtfulmoney.com. Thank you.
Okay. Well, look, if we can, let's roll up our sleeves and just grab a few of these in detail. John, why don't we come to you? I mentioned capital gains and losses. These are things that to the extent you want to use them strategically, you got to lock them in before December 31st rolls around. How do you help people think through what to do here, whether to remain in a position, whether to sell it, lock in losses? Obviously, there's danger of a wash sale too. There's a lot of things to consider here. So how would you help somebody walk through this?
Yeah, you always want to have the investment objective and realities drive the situation. Taxes should always, we think, take a second seat, but oftentimes a very important and close second seat. But especially this time of year, and especially in the context of a market that's been on a tear, and especially against the backdrop that we've already talked about with high valuations and likely a more difficult path ahead as we get further ahead. It's very important to think about, well, first of all, if you have any investments that are down, that are losers, if you want to use that terminology, one of the silver linings there is that the tax code allows you to make use of those losses and book those losses to offset other capital gains that you have. Let's say you have a stock like NVIDIA. Maybe you're one of the folks who got in early on NVIDIA and you rode that stock higher, right? And it's become an outsized portion of your portfolio. But to sell it, you would have some significant capital gains tax realization that you would have to pay taxes on. Now, I will say that capital gains taxes, especially if you hold things over a year, are pretty favorable, 15%, maybe 20% if you're in a higher tax bracket, but still very, very low and reasonable, considering the best thing to do is book gains while you have them before they evaporate, right? But you can use losses in your portfolio to offset those gains. So if you have $10,000 in losses somewhere, you can use that to offset $10,000 in gains. And you can do that, and those losses can be carried over to future years. They don't get lost. They can be carried over to future years. And even if you don't have capital gains, you can use up to $3,000 of those capital losses to offset income. That's the only time that you can use capital losses. You can use it up to $3,000 per year to offset income. I did want to show just a couple practical things, though, like on Roth conversions. And I also want to talk about tools that we have. So while we're on the topic of capital gains, let's talk about NVIDIA as an example of a stock that maybe people have that it's gone much higher. I'm going to share a chart here because we have tools where we can help folks manage the risk of something that's appreciated and hedge their risk, but still allow them to thoughtfully spread those gains out over, say, a number of tax years. So, for example, I'm going to pull up this chart. This is a chart of NVIDIA, and you can see the stock has recently reached, and this is a split earlier this year, so this is after the split. So it reached a crescendo here of, at least as of this time, of just under $153 a share. It's down at 136 and change right now, so it's pulled back recently. You'll notice I have a couple dotted lines here. These are meant to represent a hedge that we could help a client put in, a so-called collar hedge, where we can use option instruments to basically put a line in the sand. This line in the sand happens to be drawn at $130 a share. Now, from a techno-babble standpoint, and happy to talk with anybody about this, but suffice it to say, there's technical reasons why that you might call this an area of support, that if breached, we may see the stock find the path of least resistance to the downside. But we can strike a line in the sand there, so-called insurance policy, that protects that shareholder below that price. Now, we can pay for that insurance by selling a call option at 148. And this is right off the option blotter, a lot of numbers here, but basically the same cost that the put option cost to provide this hedge, we can take in the form of a call option premium. So that gives upside to 148. This is through February in this example. But you have downside protection absolutely below 130. Now we can move those, we can put the put option down here where you bear more downside. and also get yourself more upside and not have to cap the upside. But point being, there can be a strategy that could be orchestrated so that you don't have to make the choice between having a position that's gone what you might feel is way beyond itself, but have to necessarily take the tax hit all at once. That's just one example of a hedging strategy that we can use, and it can be applied to a whole bunch of positions, whether it's market indices or individual stocks. And certainly we'd be happy to talk details as relates to any one individual. So on the topic of Roth conversions, I thought we'd just quickly look at the tax brackets, because this is oftentimes what goes into the practical decisions of how much to convert, if to convert at all. So for example, this is the 2024 tax brackets for married filing jointly. You can see the 10% tax bracket for people with income, joint income up to 22,000, jumps to 12%, and that's all the way up to 89,000. And then a big jump to 22%, okay, up to 190. Bottom line, so for example, we might say, let's say there's a household that for whatever reason has low income. Maybe the spouses are unemployed for a year or something like that, or have taken a sabbatical and they don't have much income. Well, they could, for example, maybe convert a portion of their traditional IRA into a Roth and still stay in the 12% tax bracket. Or for folks that have higher incomes, you can still take perhaps up to 364 and not jump up to the 32% tax bracket. These are some of the customized things that we do with each client that talks to us about this as to whether a Roth conversion makes sense for them. And it really, again, it's got to be brought back to each individual client's situation.
Okay, and let me just make clear for folks. So, Roth conversion, we're talking about retirement accounts. Most people are probably familiar with a regular IRA versus a Roth IRA. And the Roth uses it's post-tax money in, it grows tax-free, you can withdraw it tax-free, where a standard IRA, you're putting pre-tax money in, it grows tax-free, but then you're getting taxed on it later on when you're pulling it out. Doing the math, and you've got to do the math because there's assumptions you put in place for how long it's going to be before you start taking your distributions and all that type of stuff. But there may be opportunities where pulling money out of an existing regular IRA, taking the taxes in that year, and then putting the proceeds into your Roth IRA, if you've got enough time to let that grow, that actually might be the smart move for you, right? So first off, an advisor like the team at New Harbor can be very helpful in just running the math with you and giving you the options. But just want to make it really clear for people, it's not it doesn't have to be a one and done type thing where you don't have to liquidate your regular IRA and put it all in the Roth. You can just do it in dribs and drabs over the years. And as John is saying, you might look at the tax brackets and say, okay, I can take out up to this much and put it in my Roth without triggering the next higher tax bracket, right? John, you're nodding as I'm saying this. I just wanted to make sure everybody really follows along here, that there's
right.
Lots of flexibility, lots of options here. And it's really all about determining which is best for you, given your own personal situation.
Exactly right, Adam. And it's partial conversions are absolutely allowed, and it's what we oftentimes will advise folks where it makes sense.
Okay, so I'll just reiterate so thank you for walking through those specific examples. I think you're really helping people understand exactly what needs to happen, what thought goes into this, and the benefits that they can get from each of these things. But again, folks, just a reminder, you've got to get this tax planning done in most cases by December 31st, or else the window of opportunity closes for you. And, I liken this to people, especially if you've had a good year, is it can almost be like, fumbling the ball on the goal line, right? If your portfolio has done great, to ignore some of these options right at the end can really be, a self-inflicted, own goal that you really could easily avoid just with a little bit of attention. So don't be one of those people, and don't wait to try to take advantage of this, because for two reasons. One is you may very likely not get the opportunity. Thanksgiving's next week. Thanksgiving is this week. In fact, it's probably past by the time this video is getting released. The winter holidays are not that much further away. Most people, their work gets, there's a lot of stuff that has to get wrapped up before the end of the year. Family starts visiting, you have holiday parties to go to. There's just so many demands in your time that most people just let this slip by and don't do it. The second thing is if you procrastinate and then you call a financial advisor, with only a couple of days left in the year, it's very hard for them to be able to give you sufficient focus because, there's 1,000 other people doing the same thing. So you don't want to get lost in that shuffle. Try to get out ahead of this as fast as you can. All right. Well, look, in terms of, again, keeping with sort of the themes of practicality, Mike and John, you guys talk to people all day long, both your existing clients, obviously, but also the many people that are reaching out to you through these videos with their goals, with their concerns about the markets, et cetera. So I see you guys as a really good avatar for kind of the heartbeat of the average investor. What are some of the things you're hearing right now from people? Are there concerns that are really standing out above and beyond most? Are there things that you're finding you recommend to people that you think are worth sharing with people here? Do either John or Mike, either you guys have any reports from the trenches to give here?
There's some very common themes. Obviously, people are wondering what the election, how the election will impact things. We don't think that overall the election will impact much, really. Maybe it'll actually be the fuel that causes us to have this final move higher that we think could be possible. But other than that, I don't really think that the end game is going to change much based on who's president. That's kind of baked in the cake. So that is a common conversation right now. What's common more so over the last months and even years, but certainly over the last months, conversations that I can remember talking about are the ones that are on everyone's minds. What do I do with my money? Do I have enough? Can I stop working? A lot of people are worried what happens to their spouse if something would happen to them. Had a conversation today where that was the theme. I'm a self-directed investor, but I want to make sure my wife is all set. In this case, that happened to be the husband that was a self-directed investor. It's pretty common that we have these kind of conversations. And as long as that person is able to, they feel confident that they can manage that family's finances. But if they can't or become incapacitated, or if the worst happens and they pass away, who's gonna take care of that other spouse? And it's really hard to find somebody different. Particularly the community that's watching your channel, Adam, kind of doubts the status quo. They don't think that it's going to be roses and peaches and cream forever. They think that we're approaching some kind of reckoning by and large, and they don't think that money printing is going to bail us out forever. And so these types of people that have that kind of thinking, they're really afraid of what happens to their wife in this example. If, for instance, they're not able to do it and their wife goes to a traditional financial advisor and they put them into some kind of pie chart allocation. So that's an extremely common conversation. We're having lots of those. I had a conversation just today about long-term care and Medicaid issues. There's some very simple things you can do without buying insurance, because, by the way, insurance is extremely expensive and we don't generally advocate that. I'll come right out and say that. There's other things you can do that don't cost any money that are pretty simple to do, that we'd be happy to share with people. That's common. And we're always doing financial plans for retirement, basically projecting income. And to wrap all of this up, people know that what we're living through right now is not real, or not, at least not completely real, and they don't know what to do about it. And they're just trying their best to just make sure they're okay and their family's okay. And I think that's what we're here to help them do, to get them through all that.
All right. Great, great boots on the ground reports there. I think probably most viewers saw themselves in at least one or two of those incidents that you mentioned there, Mike. I really appreciate you talking about the succession planning one, in terms of who's going to manage the family's money after I'm gone, because I know from talking to people over the years and even just the recent survey that I asked this audience to fill out, that there's a lot of people watching who are self-directed kind of DIY investors. They're watching this channel and others like it to become better informed and hopefully make smarter decisions with their money. They aren't set it and forget it people, like you said, Mike, right? They're not, they don't have an implicit trust that, oh, if I just do the standard allocation and forget about it, I'm going to be fine, right? They're worried about volatility and rockiness and potential repricing events ahead. And so they're shouldering the responsibility for their family. Okay, I'm going to be the one to navigate us through this. A lot of them don't think about, honestly, what if something happens to me? The minority that does, I think, are really doing themselves and their families a big favor. because I know you guys see this, and feel free to chime in on this. I know you guys see it when the person who is the financial quarterback for the family does die or get incapacitated before any sort of succession planning has been done, and you see the immense amount of stress and the deleterious effects that has on the family, because people who don't have these muscles, don't have the knowledge, the background, the experience to manage the investing, feel totally overwhelmed by it. And then they're kind of like lambs, right? That can get taken advantage of, the sharks on Wall Street, the wolves on Wall Street, who come in and, oh, yeah, we'll take great care of you. And then they put them in all sorts of things that generate lots of fees for the advisor, but aren't in the best interests of the client, right? I mean, that doesn't happen all the time, but it certainly happens a lot more than we'd like to see. You guys are nodding vigorously as I'm saying all this. So, John, I'll give you a quick second just to chime in on this before I wrap the point up.
Yeah, this is reminding me of a recent meeting I had with a prospective client, actually, and they had long realized they needed to put an estate plan in place, husband and wife, and for whatever reason they hadn't gotten around to it. And I was able to, in a hour-long kind of introductory meeting, convince them to let me introduce them to an estate planning attorney just for a consultation. And right there on the spot, we got a phone call out to the estate planning attorney, got them on the calendar, and they walked out. I think I read a sense of relief that they were putting things into motion, right? And all it was just getting something on the calendar. And I don't know if they'll become clients. It's not necessarily that we're the right time or fit for them, but it was fulfilling nonetheless, because I think something very positive and meaningful came out of that, and they seemed a bit relieved. So that's a big part of what we do, making sure we can kind of
Good. Well,
push things along that need tending to.
Yeah, well, that super reflects well on you guys and the integrity of your firm, that you'll do whatever's right for whomever you can. But the key underlying thing I want to speak to the people that are very admirably the financial quarterbacks for their family is you're doing it because you love your family and you want to provide for them. It's an act of love and service to come up with, okay, if I'm not around, who's it going to be? And if it's somebody in your family, great, but start grooming them, start getting them ready for that. If it's not going to be somebody in your family, and I think in a lot of cases it's not going to be, that's fine too. You can continue being the quarterback for as long as you're able to, and hopefully that's a super long time, but find the professional or whoever it's going to be that you want it to transition to once you can no longer do it, and make sure that your spouse, your family knows who they are. They've got a pre-existing relationship. Hopefully they won't need to put it into practice for decades, right? But just in case the worst happens, they've got the peace of mind, and you've got the peace of mind of knowing how that torch is going to be passed in a non-disruptive, constructive way that gives you the sense that, okay, the money is going to be managed in the same way that I am working really hard to manage it right now. Okay, I think folks probably get that. But anyways, gentlemen, we're here at the end of the time. Hope folks have liked this more sort of practical insights that you can use and immediately put into practice in your own portfolio type of discussion here. If you do, we'll continue doing this on a monthly basis going forward. I will publicly commit as well that we're going to get the Ask Anything monthly Q&As with our advisors, John and Mike, Jonathan Wellham from Canada, Lance whenever he can join. We'll start doing that too, and another monthly cadence going forward. So again, all in attempts to just give you more and more practical, actionable content going forward. So anyways, John and Mike, thanks so much. Mike, John, any last parting bits of advice you have for today's audience?
I guess I would just say I'm taking a look at our allocation here, Adam, and I know that some of your viewers want to have some ideas or at least have some concrete answers as to what we're seeing. We've been pretty open about the fact that we're ridiculously overvalued, and yet we're still in the market to the tune of 38 to 40% right now. And within that, I'd like to just share a couple insights, and then I'll close with that. We're seeing a broadening in mid caps. Small and mid caps versus the market. We look very closely at the interrelationship between different sectors and different groups. And we just raised our allocation to mid caps. And this allocation is actually presently unhedged right now to 10%. So out of the 38%, 10% of that is mid caps. And so there's a number of different ETFs one could look at if you're interested in that space. But I just know that people are interested in specific ideas, and the mid caps are breaking out. and they're outperforming, and there's no real sign that it's reversing. And so we're watching very closely to see if that continues. So other than mid caps, which have become obvious to us that they're starting to take the lead, at least short term, we also look very closely at sector relative strength. And some sectors that we're seeing incredible strength in are financials, industrials, utilities, real estate, REITs, and telecom. And these are just some of the sectors that are in our model. Each of those have representation, and they do change from time to time, even week to week. And so it's our job within our allocation of stocks to pick the very strongest ideas and the very strongest sectors. So those handful of sectors that I just mentioned, plus the mid caps broadening out, are where we're focusing right now. And our short-term indicators are now strengthening again, and we may add a few more percentage points here in the next few days. But again, what makes us different is we're not all in, and we'll take the heat for that, because you can't keep up with the S&P in a vertical up market. Our clients have come to expect that. That's what our outlook is, and so that's how we're managing.
Adam, I'd like to just say, by anecdote, comment on Mike's reference to our system of using tools to measure relative strength of different sectors. And I'll bring it back kind of full circle to the kind of maybe the outlook ahead in post-election. And I think there's a long-held belief that, for example, traditional energy companies, oil and gas companies, tend to do well in a Republican administration. And certainly Trump and several of his cabinet folks have talked about, hey, we need to increase oil production, right? If you look, and then just by way of anecdote, under Trump's first term, renewable energy did far better from an investment standpoint than traditional oil and gas energy. And the opposite was the case under Joe Biden's term. Renewable energy has been a horrible investment, irrespective of the deployments. The returns on investment have been horrible. So this just speaks to what sometimes seems to be obvious to the logical mind. The markets tell us something different. It's really important to have a system that can kind of guide you based upon the realities of the markets, not one's opinions or one's feelings or strong held beliefs. And that's what we work really hard to do.
All right. Well, look, wise worlds, gentlemen, we'll have to leave it there. Folks, if you've enjoyed this new format, would like to see us continue to evolve it, please let us know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And if you would like to get some help with anything that's been discussed in this discussion, perhaps it's some of these year-end planning steps, maybe you want to get their New Harbor free year-end planning checklist, whether it's just, transitioning who's going to take over the torch from you if you're the family's financial quarterback, really help with anything. If you don't already have a good financial advisor who can help with that, then consider scheduling a free consultation with one of the ones endorsed by Thoughtful Money, perhaps even John and Mike and their team there at New Harbor. To schedule one of those free consultations, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple seconds. These discussions are totally free. There's no commitment to work with these firms. There's no strings attached. It's just a public service they offer to try to help as many people as possible, position as prudently as possible for what may lie ahead, and help them hit their money goals and their wealth goals in life. John and Mike, as always, such a pleasure. Thanks so much for doing this, and look forward to, again, continuing to work on this format with you going forward. Everybody else, thanks so much for watching.
A lot of fun to be here, Adam. We appreciate the opportunity, and we will see you soon.
Thanks again, Adam. We appreciate what you do for Thoughtful Money. Keep it going, and looking forward to a new year in our sights here coming up soon.
Thanks, guys.